Hi, Mark. Hi, Jim. Welcome, everybody.
Hey, Casey.
We're going to give everybody a minute or two to get in here before we kick everything off. Let's see. Okay, well, I think in the interest of time, we'll go ahead and get started. Thank you all for joining us today. I'd like to welcome you to today's webinar discussing how to be profitable in the next 6 to 18 months, given the current market. This is part of the CWDL webinar series on key mortgage topics for our clients and friends in the industry. Quite timely at that. I know everybody is making tough decisions and really wants to have the insight to do that intelligently. And we're really excited to have Jim Deitch on today. He is the co-founder and CEO of Teraverde. He's joining Mark Wilson, who is the founder and managing partner of CWDL. And both Mark and Jim are former mortgage bankers. So I think the insight and perspective they're going to provide today is going to be really, really valuable. A couple of housekeeping items. Feel free to type any questions in the Q&A area, not the chat area, in the Q&A area. And we will get to all of them. Whatever we don't get to, we'll definitely follow up with. And other than that, let's get started, gentlemen.
Thanks, Casey. I'm going to jump right into it here. I think I'll give you a quick highlight of what we're going to go over and hope to accomplish. I know this is a serious time for many of you. In a very difficult market, but we're going to talk about some of the things you have control over and some of the things you don't have control over today. And we hope that at the end there's some takeaways that you can start implementing right away. So we think this is going to be a valuable time spent. So thanks for being with us. I appreciate it. So we're going to review some of the Q1 2022 performance highlights that were published by the MBA. Then we're going to review what drives profit and resilience, especially in this particular market. We're going to review what you can actually control, and it's more than you think. There's a lot of things you can be doing even in a difficult market. We're going to uncover opportunities for profitability. We're going to talk how to make every loan count and what differences you can make right away. So let's get right into it. Jim, this is some stats that came out of the MBA. Why don't you talk through what this is showing us and what some of the data that we're seeing from the industry that we can use to make some decisions.
Mark, Shirley, thank you so much. And it's a pleasure to be here. Casey, thanks for the intro. Mark, thanks for sponsoring. So what you're looking at is the history of the productivity as measured by the MBA performance reporting for closing employees, which is the closings per sales employee, which is the dark bar, and closings for fulfillment employee, which is the gold colored bar. And we're feeling pain right now in the terms of really diminished profitability. But I think the interesting thing that comes out of this data is that the issues did not begin this quarter, last quarter, the fourth quarter of last year. It actually started in the third quarter of 2020. And we've seen a decline in productivity by over 50% in that period of time. In case, if you roll the next slide, that translates into a cost per loan of about $10,600. What that does to profitability, and this is a look at profitability with respect to basis points earned of net production income. So it's all revenue, less all cost, less corporate allocation to get to what amounts to the pure pre-tax production income coming out of mortgage bankers. We had the high water mark in the third quarter of 2020 at 203 basis points. That is a record in terms of what the MBA has kept track of over the years. And 5 basis points in the most current quarter was with some of the MBA team, Mike Frattoni, 2 weeks ago. And the sense is that the second quarter of 2022 is going to be a loss for many mortgage bankers. So with that, Mark, I'll hand it back. That's kind of a quick overview of what's happening in the last 7-8 quarters.
Right. So now we got to talk about how you deal with this, these facts. 5 basis points on a net over the first quarter of 2022. I just got done visiting clients over the last week, and I think that held up pretty true that people were in the black barely in the first quarter. But many are saying that this next quarter is not going to be, they're not going to be in the black. So the timing is now to really try to get this, to get control over this. So, and there's choices. So we're going to kind of enter into what we call the no BS zone. So we're going to be real candid. You know, we care about all of our clients and industry partners out there, and we want you to be successful. So we're going to kind of tell you what you need to do to take a look at this. And it really comes to the point of, are you a company that's focused on profitability, or are you a company that focuses on volume? And there's a few ways we like to take a look at that. So what drives profitability and resilience of a lender? Are you profit driven or volume driven? And what we've seen in our experience are companies that kind of change the math and focus on what it's going to take to be profitable, as opposed to just trying to get as much volume as they possibly can at any cost, are the ones that make it. Now, a lot of people on this call are, yeah, dumb, Mark, like we can't give away the price. But what the data shows us when we dig in is there's still this mentality to just chase volume. So what can you control? You can control costs. You can control some of the profitability coming out of your loans. What you can't control is the market sets the rates and inventory sets the volume. So you have to understand the market that you're in and how you want to attack that. Jim, do you have anything you want to add to that?
I think, Mark, you said it. Profitability is a state of mind. You can start with the core presumption that we need to do what we need to do to be profitable. Start with a target, and what that target is, less the revenue that you're going to earn, gives you what cost base can be absorbed. And I think, Mark, we had lunch a couple of weeks ago, and I'll let you kind of talk about that whole targeted profit idea.
Yeah. So typically, people look at, I'm going to get as much revenue as I can. I'm going to have expenses to go ahead and get that revenue. And what am I left with is net profit. Targeted profit is different in that it says that you're going to set your profit, and then you're going to be able to size your company to what you have available to spend for everything else, all your other expenses. So it's the idea of this predictable revenue. So what you're actually going to get, not what you hope to get, but what you actually are going to get. And the good news about the mortgage industry, you know what apps you're taking, you have a fairly good idea of what your pull through is going to be. Of course, if rates go up 2% in a particular week, we understand that makes it a little difficult, obviously. But you have a pretty good idea what your revenues are going to be, at least over the next 45 days or so. And you can start right sizing your company. You say, okay, that revenue is predictable. Take 10% of that, 10% of that, and that's my profit. And that gives you a goal to how much you have available to run your company, and make steps to actually get to that number. So let's look at that a little bit closer. Jim, why don't you go ahead and talk through what we're seeing here?
Awesome. So Mark, I think you make an excellent point that there's a lot of things you can control that maybe we don't fully appreciate how much we can control. So you can't control rates in the inventory that's out there. That sets the volume, and that's that blue line. So that 372 basis points, that's what is really out of our control. But what's in our control is everything in green. Compensation makes up about 2/3 of the cost of the industry structure. It's been that way for the last 8 or 9 years, and that's a very, very, very high part of labor component. You know, tech spend is 11 basis points. You'd expect to get some leverage on that and get some cost saves and efficiency. But I don't think we've realized all we can. We'll come talk about how you might look at that tech spend and really use some of the information you can get out of it to control what you may not necessarily feel you can control all the time. So when we look at all those elements of cost, getting down to 360 basis points, you're left with 12 basis points as the industry. That's what the industry on the retail side earned, just as a matter of comparison. So let's say we wanted to do 20 basis points better. And if we flip to the next side that says we're going to be profit driven, and we say, look, maybe 10% of profit's a big number to start with. Let's start with 32 basis points is our target. That means we've got to pick up 20 basis points. So where do we pick it up? It's not going to come out of revenue, but it probably initially can come out of comp. So if we roll in that slide, what you'll see is we essentially have to get that 20 basis points, some out of sales, some out of operations. And we're not talking about, let's just go terminate people. That's not what we're really offering here. It's how do you go through and find the efficiencies that you can get out of your team and then manage everybody up to that expectation. And hopefully the efficiency improvement will get us there. If not, then you have some decisions with respect to your overall body of costs. But let's start by looking for opportunities to, really top grade, top tier the employee base that you have. So Mark?
Yeah, so how can we manage costs? I mean, we're going to talk about those particular topics as it relates to compensation and areas that we can focus on to improve those areas. And so let's look at it. So let's take a sample of underwriter productivity and what this data is telling us. So here's a snapshot of some real data. The parties involved are not real, but the data is. This is from actual client data. Jim, you want to talk through what we're looking at here?
Sure. So what we've done is captured the essence of underwriting. And I know it's a little hard to read, so we're going to skip to the next frame in just a second. But
sorry about that. I'll go back.
No worries. That was a setup, Mark. Well, just gives us see how quick on the draw you were.
Yeah.
So what we're looking at is cases decisioned, which is right here. We're looking at the ranking in terms of quartiles. So basically breaking the underwriting team into the top quartile, the next quartile, and so forth. This is the history of the underwriting cases decisioned over time. This is turnaround time. Anything in blue is good. Anything in red is slower than the company average. And this is declinations and how fast declinations are made. So this is kind of the overall summary. We're going to hone in on two groups. We're going to hone in on the top 4 underwriters. And if we look at this, the cases decision here is averaging around 700 over the last 12 months. And the speed of the decision is around 21 days. And that puts these underwriters at the top of the tier. And then we have the average underwriters. And the average underwriters who are in the middle of the pack, that 2.5 quartile, doing about 330 cases and doing it in a little over 30 days. So what comes out of this is speed to decision, throughput is really pretty definable for underwriters. And the interesting point of this is, what does that have as an impact on cost? So if we flip to the next slide and we look at those top 4 underwriters, this was an aha moment for me. When I say aha, it means, wow, that's an interesting observation that was buried in all the statistics, but now all of a sudden pops out as aha. So the top tier group decisioned 736 cases over the last 12 months. They did it in 20 days. And using a cost per underwriter, including benefits all in and support, which for this case, we're using 125,000 just as an example. The top tier cost per decision was 170 bucks. The average was 408. The bottom quartile was 592. So the difference between that top four and the bottom four is almost $400 per case. So Mark, you made an observation about a lender that's doing 100 units a month. I thought that's worth repeating.
Well, I mean, if you were doing 100 units, $40,000, right? So just simple math. You know, it's underwriting costs 66% improvement, and this is chance for leadership to be leaders and discover why there's such a big difference between the two, and also have an opportunity to reward those performers in the company and really make sure they're making these tough decisions that they might have to make based on real data, right? I mean, there's a drastic difference even between the average. I mean, between the average and the top tier is a significant difference. And, you know, maybe it's a training issue. Maybe there's other things that are involved. Maybe they're used to crazy volumes and the expectation on how long it makes a decision is to be made is different than they're used to because they're coming out of a different type of market than we're in today. So lots goes into this, but the numbers are significant and should not be ignored.
One of the things that one of my associates mentioned to me early today, he said, so if this is the difference in cost and the productivity of underwriters is so varying, and again, this is actual data. This is not data that is exemplified. This is actually from one of our lenders that lets us use this data, but it's very similar as we look at this and look at some of the peer averages. This is not an unusual spread. So one of our newer associates said, well, Jim, you must pay these underwriters. Lenders must pay these underwriters a lot less. So if someone's average and they're here, they probably make a lot less than this. The person down here makes a lot less than the person up here makes a lot more. And the answer was, actually, the difference here is amazingly tight compared to the dispersion here.
It's not $40,000 less, you know, or per underwriter, or whatever that adds up to be per underwriter, right?
So if you take away from this discussion, and we're using underwriters as just an example, every element, Mark, I think you can comment on this in just a second. It's really looking at everything, not just the easy things, but everything. What's the productivity of every position? What's the productivity of your tech stack? Is it configured to do what you want it to do? What is the efficacy of all your support departments? You can top tier almost anything.
Yeah, marketing efforts, all kinds of things, right?
Yeah. Go ahead, Mark.
No, that's good. So let's talk about the people who are out there bringing in the revenue. LOs, AEs, production managers. How can we look at those individuals more than just volume? I mean, volume, we've already kind of, we did a hint, isn't the only thing that you should be looking at. So here is some more data. Talk through this a little bit, Jim, if you don't mind. What are we seeing here?
Awesome. We'll do that. And also would invite everyone who's with us today, please feel free to put some questions into the Q&A. Mark and I would be happy to do that. We reserve some time at the end to have some question and answer and just a broad discussion. So what you're looking at here is a similar thing for loan officers. And one of the elements that occurred and was pretty influential in my mortgage banking career was I ended up at an MBA function and sat next to Billy Bean, who is the assistant general manager now, the general manager and executive vice president of Oakland Athletics. And we talked about baseball. And one of the things that Billy said is, you know, I understand a little bit about your industry. In baseball, we measure the efficiency and the efficacy of just about everything. So what do you guys measure? And he threw out the concept of metrics that matter. So to me, the metrics that matter are what's your volume, which is here. What's the trend? So you can see visually what's happening with each originator. What's the best efforts margin they're earning. You can see the trend on that margin. What is their speed to decision, speed to close? Blue is good, red is slow. And what's the pull through? So how is that pull through coming in? And using a system of some algorithms, we come up and we rank those producers based upon those 4 metrics. Now, here's the interesting thing, and I know this is hard to read. I'm going to show you a blow up. To Mark's point, I think he made a super observation. Volume is not everything. So we have a matched pair set here. We have Kip Bergdahl, who's it's a made up name, it's anonymized, that's doing about 25 million, and Latosha Moore, who's doing about 25 million. So let's take a dive on that and see what the differences are. So the aha moment here, and I'll just walk you through this, is that the volume's pretty much the same, but the margin is significantly different. This is a mix issue. It's a pull-through issue, which you can see here. It's a less cures issue. It's a much lower level of concessions issue. So if you look at the volume and just take it simply by the achieved margin, which includes concessions, fallout, et cetera, this individual produced $1.3 million of essentially contribution margin or revenue from which this individual's commissions can be paid. Same volume, but margin much less. Some of the reasons: the turn time days was pretty long, resulting in customer dissatisfaction and concessions to kind of keep the deals. Pull through is a little bit lower because of turn time and general customer service. But what comes through here is
Did we lose you, Jim?
Kip Bergdahl produces, Latosha is $23 million of revenue and is $674,000 and is paid 100 basis points. So the compensation is the same, but what happens to the company is Kip is about 3 times as profitable to the company as Latosha, even though the volumes are pretty close. So Mark, you have some observations on that too.
Yeah, I was visiting with a client last month. An issue could be that you might have a branch manager that's paid on volume, and we have to be careful on compensation rules as it relates to that. But what's interesting is if you might have somebody that's putting through a bunch of concessions and other things just to get the deal done. This also creates a good opportunity to challenge your leaders to get the deal done without that fits into the company's profit metrics, and making those parameters to guarantee so you can be profitable. Yeah. And I always say compensation plans are to get the behavior that you need that you're looking for. So if you're strictly paying individuals based on volume and only volume over time, that might not be the best model for compensation. There might be some targeted things that you need to do to make sure that your company can survive, especially through markets like we're in today.
So Mark, you make a really interesting point. The data set from this particular lender is that they run 2 different compensation systems for the branch and the regions. One is a profit-based branch that conforms to all of the requirements for non-producing branch managers. The other is a branch managers that are paid strictly on volume with overrides. Would you like to guess where Kip Bergdahl works?
Yeah, it's interesting. We did not talk about that when we looked at this data set. So it's just interesting, right? Because we see that across the board. So obviously those of you who are listening, look at your models and really try to understand what you might need to do to make sure that you're profitable.
Mark, if we can just, can we just go back and kind of expand on that, because we have a little bit of time.
Sure.
One of the elements that I think is really important in the current business environment is to align the interests of the employee team and the company. So, and I'm not advocating a P&L branch is the right way to go, or a corporate branch is the right way to go, or any particular compensation system is the right way to go. But the alignment of when the company makes money, everybody else makes money is a really important thought. I was talking with one of our partners and specifically went through, is it the right way to pay operational people, given what we've come through on cases, and literally we've ratcheted up the salary to try and keep people. Now what do we do? And it's a great question. So Mark, when 6 months ago, 8 months ago, 10 months ago, when we really had, how do we get people, how do we keep people, and we increase the cost base of the entity, what are you seeing your clients doing to manage those costs?
A lot of them are making really tough decisions. We've had clients, obviously they're going through layoffs. They're trying to match that to what, they're good performers, and trying to keep them on board, understanding that this business goes through these peaks and valleys, and that's difficult. We've seen some clients do across the board pay cuts, a combination of layoffs and pay cuts, and some are doing there. We do have clients that are doing well too, and just kind of holding true. I think that all comes down to the client, their particular situation. Can they be profitable, behaving in the same manner that they have been behaving? Then they're not going to change. Obviously, in this industry, there are profit covenants, there's net worth requirements, and they don't have the luxury of showing multiple quarters of losses and keep those relationships. And although the counterparties are going to be somewhat understanding that the market that they're in, they tend to lose patience over time, and we've seen that. We saw that a lot in 2018, and where margins were drastically going down, and it's those are the tough decisions. So digging in and understanding your data is really the only option to make sure that you're making the right decisions. And this is a good example of what you can do. I mean, maybe your LO here that might not be performing as well feels like they're doing great because their volume's good. They need to understand what good volume looks like, and help them, coach them through that, and that's your sales leaders hopefully understand that, and hopefully you have a compensation plan that rewards the right type of volume too.
So Mark, we said at the very beginning, this is a no BS bowl,
That's right.
no BS zone. So one of the things I just want to throw at you, and we didn't talk about this, so it's a surprise coming out of left field, but here it comes.
Mm-hmm.
Was talking with some of the people at the MBA of Florida last week, and a little bit before a different event. And one of the economists said, the industry has to absorb the fact that the volume is going to be 40-45% lower, that margins are compressed, and the 400,000 people that are employed in our industry is going to have to be rationalized quickly, else you give back a large amount of the equity you earned over the last 2 years. in the opening slide, you saw that this isn't something that's just happening. There's been a decline of productivity over the last 8 quarters. So my no BS zone question to you is, why do we as an industry kind of wait until we hit the profit loss zone of right above, right below, and just kind of defer this? What do you think the teams on the phone today really need to be thinking about where we go the next 2-3 quarters?
Yeah, I can answer that as an entrepreneur. We're entrepreneurs are a group of people who want to build and create environments and cultures that are growth minded and want the line to always go the other direction. And so coming to terms of understanding that we're in a market that is going to be more difficult, you have to make these tough decisions. And this is when you really get to prove what kind of entrepreneur and leader you're going to be. Are you going to sustain this difficult market so you can build and grow and do that again in the next cycle? And that's not to say there's not individuals will be able to grow. I mean, there's all kinds of M&A transactions going on. There's all kinds of JVs happening. People are being nimble. People are looking. People are prepared for this moment. Companies that are smart and leadership who makes these smart, sometimes very difficult decisions will be much stronger, better companies coming out of it. And some of our younger clients who haven't, or younger companies that haven't been through a major cycle before are, we hope they don't learn the hard way. And we hope that they learn by listening and talking to other people who may have gone through this before. Certainly when I owned a mortgage company, I had to learn the hard way. I held on to some of the things that we were doing too long because I was worried about culture and other things that go into that. And I think you should still worry about culture. I will tell you, I had a conversation with a client last week who was looking at, is it better to lay off some of their people, or is it better to do a pay cut across the board? My answer was, if you have a group of individuals that your team knows are underperformers and you keep them and you do a pay cut across the board, that's not going to help your culture, because the people who just took a pay cut who are performers are going to be disappointed that they're carrying some of those underperformers. So to the point of, this is the no BS zone, it's a combination, it's an and decision. It's looking at all of these things, but following the formula of predictable revenue minus profit equals how much you have to spend will help make those decisions, because those are numbers driven. And oftentimes we, as entrepreneurs, we make decisions that are emotional, but I also know that most of them from your gut, what you have to do. And the longer it takes to make that decision will determine perhaps where you go from there. So anyway, so I don't know if that was a long answer to your question, but.
No, it's a great answer, because it really is that there's a balance between culture and metrics, but metrics provide the fact base, the culture is the emotion base, and you've got to really go through and blend both the fact base and the emotion, the cultural element of it, to determine how we're going to go and how we're going to do. So I appreciate your insight. Thank you.
Yeah. But with the right culture can beat strategy even in difficult markets. So I think it's really understanding the company you have and how you're set up for that. So, but yeah. All right. So going on, we have a few more good slides here. How do you make every loan count? And And so why don't we go through there? Here's a branch scorecard. And Jim, why don't you talk through a little bit about what we're seeing here?
Yeah, so this is really looking at branch performance. And again, I realize you can't see things, but what you can do is green is good, red is not so good. So we've got the credit box here together with approval, withdrawal, declination, and volume in units. One of the elements, and we could flip to the next slide. One of the elements that was really interesting, I had a conversation with a CEO last week, and one of the questions I asked was, your withdrawal rate's pretty high. Tell me about that. And the answer was, well, that's just a cost of doing business. Not all loans close. So that had us take a look at this data. And this is not that CEO's data, it's a different company. But here's some interesting things. If you look at branch 25 and branch 31 in this case, the credit metrics are almost identical. I mean, almost identical. But the withdrawal rate on branch 25 and the withdrawal rate on branch 31 are almost, it's almost twice in 31 what it is in 25. So the question comes up then is a withdrawal loan where the customer says no and we're probably going to say yes. We've spent the time and money to take that application. We've gotten through some of the front end on it. We disclosed it, probably got to processing, may have gotten to underwriting. So we looked at kind of the withdrawals and where they went. And interestingly, some of these loans were fairly far in the system. It was beyond the RESPA app. This is closing. It kind of looked like this. So a lot of them got to the point it was either pre-underwritten or was conditionally approved. So the question is, what's this really mean in terms of numbers? So the next slide goes through and says, here's the credit metrics, were almost identical. Here are the volumes of loans that were closed. If we simply went through and said, and we improved branch 31, so this isn't a cost of doing business, but actually add 8-9 points of pull through out of withdrawal, the impact on that, it's like doing $16 million of volume that literally dropped out of the sky because those loans were already in the system, they just were withdrawn. So the question then is, if you do that, how do you move the withdrawal rate? And Marco, anything you want to comment on, or we can flip to the next slide?
No, just back to a challenge of leadership. I mean, areas to look at to discover what's going on here.
Yeah. So here's the interesting thing. So these are the branch employees, and blue is closed, green is withdrawn, and yellow is declined. So if you wanted to move the needle on withdrawals, this is a roadmap as to where you might work. And particularly for someone that's got a 60-65% pull through, probably worth sitting down and saying, why is this volume of loans literally not being closed? What is it about the characteristics of these loans? And we're not going to go through it here, but this is classic behavior of volume is good. If it's easy, I'll do it. If not, I'm not going to do it because I'm just going to keep on pushing. The issue on this particular loan officer was more of skill, follow-up, turn time lengthening, etc. And the branch manager that you pay really ought to be paying attention to what is happening here. And ultimately, the good news on this story is that the coaching of that branch manager, once it became clear that withdrawals are not necessarily a cost of doing business, they're a lost opportunity. And the lost opportunity can be recovered a couple of different ways. One of our clients, when a loan withdraws, they immediately take it to HMDA status of withdrawn, and have a direct outreach from a different unit that is purely a call center outreach and a much lower commission that goes to that customer and says, look, we approved you. You're not going to go to the business with it. What do I need to do to earn the business? And interestingly enough, they can recover 25 to 35 to 40% of the loans it withdrew simply by giving a second shot at it and talking to it. The main reason that the loans in this particular case withdrew was that the attention to getting the loan done, the attention to communicating with the customer, the attention to going through that extra mile to make sure that customer felt appreciated, felt informed, was really the reason that a large number of this particular originator's loans did not close. And when that behavior was adjusted, you saw the number literally get better, which meant this particular originator improved customer experience, improved their paycheck, and improve the customer's profitability, because the loans that were literally falling through their fingers, a portion of those were recovered. And ultimately, that's the job of a branch manager. That's the job of the overall management, is to find these little aha moments to say, let's work on this. And Mark, I don't think we're going to find one magic solution that says do this and everything gets better. It's these little tiny pickups here, a little there, a little here, a little there, that when you add them together, you get that 20 basis points that you're looking for. So Mark?
Well, that's great. I think that's good. Let's kind of go through what the next steps here. So, hopefully what you're taking out is commit to be profit driven and not just volume driven. I think those are the clients that we see that are the most successful. Commit to aggressive productivity management of every team member. 2/3 of your costs are compensation. So pay attention to that. Make sure that volume isn't driving commissions when there's a whole ton of concessions going on. Making sure you're paying attention to all the people that are working for you, and that they are being efficient as possible. In this market, it's tougher to hide when you're in this type of market. Seek aha moments, meaningful leverage points to manage profitability, productivity, and cost. You all have aha moments. I think all of us as entrepreneurs can agree there's all these hidden gems or hidden opportunities to save on costs. And I know I stumble on those even through the firm at every now and then. I know there are companies out there that are offering 50% off of floods, and there's a lot of commoditized services out there you can look into and look for better opportunities. Talk to your peer group about that and find those other costs in addition to that. Be proactive. Don't wait too long until you've given back all the net worth that you've realized over the last couple of years, and put some independent eyes on your company. Obviously, that's something that we do here. We're happy to help you look at that. And obviously, so we've partnered with Teraverde. We have kind of trying to find a way to get this data to you. So we've gone through that. So if you want, we can look at you. I hate doing that. I always feel like I'm being salesy here, but we want you all to do well. We want to make sure we're giving you access to this data. We try to come up with a way to do this really at a very, very low target number, so we can dig in and give you some actionable items if you'd like us to do that. So we can load you on to the top tiering system and take a look at your last 12 months. And we're doing that at super low, $2,500 if you want us to do that. But more importantly, if you choose to do it on your own, we encourage you to do that. If you have questions, please always reach out and ask me. We're here to help you. Jim and I's contact number are here. So if you want us to help put you in the top tier system, let us know. If you have questions about what's going on in the marketplace, please always feel free to reach out and ask us. And if there's anything else you ever need, please don't hesitate to call us. I don't know. I didn't see any questions come through. Casey or Rachel or anybody, did we have any questions come through that we didn't get a chance to answer?
No questions actually came through. My question is, why isn't my number on there? Because I'm kidding.
Yeah, no, you're right. You're right.
I should put my number on there.
Yeah. That's we can send that out as a follow-up, also email, if you want to reach out and ask any other questions. But I think there's a ton of opportunity in every market. I hesitate to say that, we talked about how difficult things are right now, but at the end of the day, it's a chance for leadership to really make a difference and position themselves for when the market changes a little bit, in the future here. So I challenge you all to do that. Have the courage to look at these things, follow your gut, and dig into the numbers, because they have the answers that you need.
Yeah, and we will be sending out a recording of the webinar probably tomorrow. So keep an eye out for that. There's a survey at the end of it. We like everybody to take if they have just a quick minute. It allows us to make sure that for the next webinar topics, we're top of mind and making sure we're bringing you guys exactly what you're looking for. And yeah, other than that, great webinar, you guys. Really, really helpful stuff here. And please feel free to reach out.
Awesome. Casey, thank you very much for having me. Appreciate it.
You bet, Jim. Thank you.
Mark, thank you. Excellent insights. Thank you so much. And there's a question there, I see at the bottom.
I think
yeah, the slide deck. Yeah, the slide deck and recording will be available. I think
yes.
That was the right Q&A.
Yeah, okay, Jerry. Thanks.
Yeah, it's coming out by tomorrow. Okay.
All right.
Thank
Thanks
you, everybody.
all. All right. Cheers. Bye.
Thank you.